This could be one of the most beneficial videos for any trader struggling to understand the difference between relative strength and the relative strength index. Here's a staggering fact. Mark Minervini and David Ryan made millions using William O'Neill's RS system, yet 90% of new traders completely confuse it with RSI. And this confusion is costing them both time and money, hours in screening, and thousands in missed opportunities and poor entries. In this video, I will break down the RS and the RSI to clear this confusion. I'm going to show you exactly why this confusion exists, how these two completely different tools work, and most importantly, how legendary traders like Minervini use the correct one to generate extraordinary returns. Talking of returns, let me show you my consistently strong equity curve over the past 3 decades that comes from my lateral breakout strategy. Alongside the returns, the supporting statistics are just as compelling, especially considering the low-risk nature of this approach. I've spent over 30 years refining this system and have compiled it into a detailed strategy PDF designed to help beginner traders dramatically accelerate their learning curve. To make implementation faster, I've also built a bespoke breakout scanner that scans for high-potential, low-risk breakout candidates across major global markets, saving hours compared to traditional screening methods. So, even if you have a demanding full-time job, but still want to generate better returns on your capital from equities, these tools are designed with you in mind. If you'd like to learn more or be part of the group, check out the links in the description below. With that said, let's dive in. Let me start with the core distinction that most traders miss entirely. Relative strength, or RS, measures how a stock performs compared to other stocks or broad market indices. It's about ranking and comparison within the universe of available stocks. The Relative Strength Index, or RSI, measures how a stock performs compared to its own past price performance. It's an internal momentum oscillator. Think of it this way. RS asks, how is this stock doing versus everything else? Whilst RSI asks, how is this stock doing versus itself? This fundamental difference in what they're measuring leads traders in completely different directions. One identifies market leaders before they explode, the other scares new traders and keeps them away from trending stocks by labeling them as overbought. Here's how William O'Neill's revolutionary RS ranking system actually works, and why it's so powerful. O'Neill created a percentile ranking system where all stocks are ranked based on their 1-year performance. Let me show you with a simple example. If we have 30 stocks in our universe, we sort them by performance and assign rankings in deciles. The top 3 performers fall into the 90+ RS ranking. These are your market leaders. The next 3 get 80+ rankings, and so on down the line. Here's the critical insight. This list is dynamic. It calculates performance from the current date going back 1 year, not calendar year performance. This means the rankings constantly update based on rolling 12-month performance. O'Neill's research from the 1950s through to 2008 revealed something extraordinary. The average RS rating of the best performing stocks before their major run-ups was 87. Think about that. The biggest winners were already outperforming 9 out of 10 stocks before they made their most explosive moves. As O'Neill stated in his book, the rule for those determined to be big winners in the stock market is look for genuine leaders and avoid laggards. Don't buy stocks with relative strength ratings in the 40s, 50s, or 60s. This is exactly how Mark Minervini and David Ryan generated their legendary returns. They followed this principle religiously. Now, there are other ways to assess relative strength beyond O'Neill's formal ranking system. These methods may not be as objectively quantified, but they're more observatory in nature, and you'll only master them after spending considerable time observing and trading markets. For example, one simple way to identify high RS stocks is to measure their performance against a broad market index. Some charting and trading platforms allow you to plot a relative strength line that does the comparison for you. Picture this. The markets are in correction, yet there's a set of stocks posting positive returns over the last 3 months. That divergence is relative strength in action. These stocks could be the emerging leaders of the next bull market, ready to explode once the broader market stops falling. To make this even more practical, first identify a leading sector by comparing its index performance to other sectors and a broad market index like the S&P 500 or Nasdaq 100. Then, within that leading sector, compare all the individual stocks, rank them, and pick the top performers as your candidates. Let me show you how this played out in actual market leaders. Here's Zoom in 2020. While the Nasdaq 100 was crashing during the pandemic sell-off, Zoom was exploding upward. The worst week for the index was literally the best week on Zoom's chart. That's massive relative strength in action. As soon as the markets recovered, Zoom delivered a 5x return in less than 8 months. This is the power of identifying stocks with superior relative strength during market stress. Look at Palantir in 2023. While the markets recovered about 50% from correction lows, Palantir was up over 200% from its low. It went on to become a super multi-bagger, rising another 8 times over 2 years. This is what genuine relative strength looks like: stocks that dramatically outperform during both down markets and recovery phases. Now, let's address the Relative Strength Index, or RSI, and its proper application. RSI is an oscillating indicator that compares a stock's strength on up days versus its weakness in down days over a look-back period. When there are more and bigger up days than down days in the period, the reading moves towards the upper band, approaching overbought levels of over 70. Here's where most novice traders fail. They assume overbought means the stock will immediately reverse and fall. This is completely wrong. Trending stocks, especially market leaders, remain overbought for weeks before any meaningful pullback. A tactical use of RSI could be timing pullback entries in stocks that already show strong relative strength. You start with RS to identify the leaders, then use RSI on weekly charts to time your entries. Let me show you how to use both tools correctly together. Going back to Zoom, it showed overbought readings above 70 on the weekly RSI in mid-February 2020. The proper approach is to wait for the RSI to drop back below 70 and then start building positions, completing your position when RSI returns above 70. Zoom offered 4 such pullback opportunities, with the second being most rewarding, as the stock surged over 150% in just a few weeks. Palantir provided 2 similar opportunities during its massive run. But here's the crucial point. This works best with stocks that first pass the relative strength filter. You cannot apply this to random stocks hitting overbought levels. The reason is simple. RS leaders are under institutional accumulation with big money following them, while random overbought stocks may lack this institutional support. Starting with RS narrows your universe from hundreds of potentially overbought stocks to just the genuine leaders worth your attention. The difference between RS and RSI isn't just academic. It's the difference between following institutional money into market leaders and chasing random momentum plays that often fall. Don't forget, relative strength identifies the leaders before they make their biggest moves. The average RS rating of major winners was 87. They were already outperforming 9 out of 10 stocks before their explosive advances. RSI can serve as one of your timing tools, but only after you've identified genuine leaders through relative strength analysis. Here's what separates profitable traders from the struggling masses. The profitable ones understand that successful trading isn't about finding the perfect indicator. It's about using the right tool for the right job at the right time. Most traders are looking for shortcuts and magic formulas, but the real edge comes from understanding principles that have worked for over a century, from Wyckoff to O'Neill to today's market leaders. If you're serious about improving your trading results, stop confusing these 2 completely different tools. Start with relative strength to identify tomorrow's leaders, and then screen for setups in those names to time your entries in those leaders. You can use RSI as one of the setup tools. It goes without saying, regardless of your confidence in scanning and setups, Always enter the trade with a stop loss. That is non-negotiable. Your trading success depends on understanding these fundamentals. Don't let confusion cost you the next big winner. Thanks for watching.